A. Prepare and analyze common-size financial statements, vertical analysis. Common-size financial statements express each line item as a percentage of a base amount to facilitate analysis and comparison. On the balance sheet, each asset, liability, and equity item is shown as a percentage of total assets. On the income statement, each item is expressed as a percentage of net sales. This vertical analysis standardizes data, making it easier to compare companies of different sizes or assess structural changes over time. Vertical analysis highlights financial structure and cost composition. For example, increasing inventory as a percentage of total assets may signal overstocking or slower turnover. On the income statement, changes in gross margin or operating expense percentages help identify shifts in cost control, pricing strategy, or profitability trends. Managers use common-size statements to assess operational efficiency and financial health. By analyzing expense ratios, asset mix, and capital structure proportions, decision-makers can evaluate performance drivers, detect unusual patterns, and benchmark against industry averages to support strategic planning. B. Prepare comparative financial statement horizontal analysis. Horizontal analysis evaluates year-over-year changes by comparing financial statement items to a base year. Each line item's dollar change and percentage change are calculated relative to the prior or base period. This approach identifies growth patterns, volatility, and emerging financial risks. Trend analysis helps assess performance sustainability. Consistent revenue growth accompanied by disproportionate increases in operating expenses may indicate margin pressure. Similarly, rapid increases in receivables compared to sales may suggest collection issues or revenue recognition concerns. Comparative analysis strengthens forecasting and strategic decision-making. By identifying accelerating or declining trends in assets, liabilities, revenues, and expenses, management can anticipate resource needs, adjust budgets, manage liquidity, and implement corrective actions before issues become critical. C. Calculate the growth rate of individual line items. Growth rate measures the percentage change in a financial statement item from one period to another. This metric helps evaluate performance momentum and operational scalability. Analyzing individual line item growth provides deeper insight than overall revenue growth alone. For example, if operating income grows slower than sales, it may indicate rising costs or declining efficiency. Conversely, asset growth exceeding revenue growth may signal underutilized capacity. Growth analysis supports valuation and planning. Investors and managers assess whether growth is sustainable, profitable, and aligned with strategic goals. Understanding growth drivers allows organizations to prioritize high-return initiatives and manage risk effectively. D. Analyze financial statement data to identify patterns and trends for decision-making. Financial statement analysis integrates vertical, horizontal, and growth techniques to detect meaningful patterns. Identifying recurring cost increases, declining margins, or rising leverage enables management to pinpoint operational inefficiencies or financial risks. Trend identification supports strategic resource allocation. For example, sustained improvements in asset turnover may justify capacity expansion, while deteriorating liquidity ratios may require working capital management improvements. Effective analysis translates numbers into actionable insights. Managers use pattern recognition to forecast performance, adjust pricing strategies, control expenses, evaluate investment opportunities, and maintain financial stability, ensuring informed and data-driven business decisions.